Hello learners and welcome to the Financial Management course. My name is Matrika Prasad Sharma, your course coordinator for management. In today's session, we will be diving real deep into the topic, and that is Introduction to Financial Management. I'm excited to take you through this journey and help you build a very strong understanding on the prudent management of finances. Imagine you are the financial manager of a growing company. Your role is to ensure the business stays profitable and at the same time sustainable while planning for the future growth as well. However, you face challenges like balancing investments, managing day-to-day expenses, and of course, ensuring timely returns for all the stakeholders. In this situation, how would you define financial management, and why do you think understanding its core elements such as budgeting, risk management, and the capital allocation is very much crucial for the success of the organization? At the end of this topic, you will be able to define the concept and significance of financial management. You should be able to discuss by the end of the session all the elements of financial management. Financial management embraces all managerial activities like strategic planning, organizing, directing, and controlling of financial resources to achieve organizational goals while maximizing wealth and ensuring financial stability. Let us now try to understand one of the basic questions that our finance managers seek answers for. First is how much money is required to start the business and also to keep the business running. How much money should be spent on purchasing various assets? What is the amount of money to be spent on buying fixed assets such as machinery, furniture, and so on? How much money should be spent on construction of a building? How much money should be spent on buying current assets like stock, etc.? Once this is decided, the next question arises: what are the sources for raising funds? How much money should be raised from each of these sources? For example, if 3 to 4 sources are identified, what should be the mix of each of these sources? How much money should be spent on day-to-day operations? How much money should the organization spend on each of these expenses to keep the business running? Now, if you look at these set of questions, you will find one thing which is common: money. Therefore, what is financial management? Financial management is the art and science of managing money in a business organizations. Now, let us look at why financial management is an important function in an organization. If you look at a business organization or a business enterprise, you may find that it is a collection of variety of flow of funds. Whatever the business may be, it has a lot of money inflows and outflows on a daily basis. Inflows. What are the inflows of funds to a business organization? Whenever the capital is broken by the owners, whenever the organization borrows money from financial institutions or individuals, when the goods are sold on cash, or when the money is collected from these customers to whom goods were sold on credit in the past. Other inflows like interest received, commission received, so on and so forth. These are all money flowing into the organization. Outflows. Outflows. An organization has a variety of purposes for which the money is paid out of the organization. Purchase of asset, payment of various expenses like salary, electricity, rent, commission, taxes, and so on represents the outflow of money from an organization. Now, the success of a business enterprise depends on how it is able to efficiently manage these inflows and outflows. It is not enough if inflows match the outflows. The organization should also be able to make profit in the process. Therefore, the success of a business enterprise depends on the efficiency of managing these flows of funds. That is the reason why financial management is considered to be the life of a business enterprise. According to Mr. Dave Ramsey, you must gain control over your money, or the lack of it will forever control you. Let's now understand the significance of financial management. Financial management allows for optimal allocation of resources, maximizing profitability, risk management, decision making, enhancing stakeholder confidence, long-term sustainability. Now let us look at what are the broad areas of activities or elements of financial management. It is broadly classified into financial planning, financial decisions, and financial control. Now let us look at each of them in detail. Financial planning means planning all the activities conducted by the financial management department, just like any other functional area in management. Financial management starts with planning. What are the plans made by finance department? Estimation of fund requirements. How much money is required? What is the amount of money that a business organization needs in the future? Planning sources of financing. Once they have planned the amount of money required, the next question is, where do I get the money from? Planning funding schedule and schedule for various expenditures. It is not necessary that the entire money required by the organization should be made available on day one. The funding can be spread over a period of time. So there should be a schedule made for funding activities. Finally, the finance department also gets involved into profit planning. Let us look at the broad areas where financial decision making happens. Evaluation and selection of capital projects. Whenever a new business project or a proposal comes in, the finance manager has to evaluate this proposal. There are scientific ways of evaluating these proposals. Using these scientific techniques, the finance manager has to evaluate the projects and decide whether these projects are profitable or not. The financial manager must also take the position of rejecting these business proposals. Deciding the mix of financing. Financing can be broadly classified into two types. One is debt, that represents the borrowed money, and the other is equity. So the finance department has to decide the mix of the financing. Should there be 50% debt and 50% equity, or should it be 60% debt and 40% equity? Deciding the investment in short-term assets. How much money should be invested in short-term assets like stock, raw materials, and so on? How much money should be invested and how much money should be available in liquid cash for meeting daily operations, etc. Deciding various financial policies. The finance department also has to decide on financial policies like credit policy, cash management policy, and so on. Financial control. Like every managerial function, control is also an important aspect. Therefore, the finance department has to control the inflows and outflows of cash, monitor and control the cash inflows, monitor and control cash outflows, and cost control. The finance management department is also interested in controlling and producing cost incurred by an organization, because every part of it, like cost sale, adds to the profit of the organization. So we have seen that the financial management department's functions start with planning, decision making, and ends with controlling all the flows of funds in an organization. Let us summarize what we have learned in this session. We have understood what is the meaning of financial management. We have also understood what is the significance of financial management. We have also seen what are the varied elements of financial management. You may please refer to the reading materials for more details. That's all for today. Thank you and happy learning.